About a week ago, the Federal Reserve made a decision that directly changes how much your idle cash is earning right now. Most people didn't notice. They don't track FOMC meetings. But there's a tax that just got recalculated because of it, one I call the idle cash tax. It's not charged by the government. It's the cost of leaving your cash sitting in a checking account instead of somewhere that actually pays you. On $10,000 sitting idle, that tax now runs roughly $360 a year. Give me the next 9 minutes, and I'll show you exactly what the Fed just did, why it matters more than it sounds like, and the 5-minute fix that cancels this tax before the Fed's next meeting changes the math again. Here's what actually happened. On June 17, 2026, the Federal Reserve held its rate steady at 3.50% to 3.75%. No cut. No hike. The pause. That might sound like nothing happened. It's actually the opposite. It means the yield you can lock in right now is stable, at least until the next meeting on July 28th and 29th. That's roughly 5 weeks from today. After that, everything could move again. Here's why that matters to your bank account specifically. A money market fund takes your idle cash and places it into ultra-safe, short-term government securities, treasury bills, mostly maturing in days or weeks. In exchange, you earn monthly interest that moves in lockstep with the Fed's rate. Right now, the largest fund of its kind, Vanguard's VMFXX, carries a 7-day SEC yield of around 3.6%. That's down from 5.3% back in mid-2024, before the Fed's cutting cycle began. But because the Fed just paused instead of cutting again, that 3.6% is holding steady, for now. The Fed's own June dot plot, their quarterly projection of where rates are headed, still points lower over the next couple of years, even with this pause. Which means this isn't a permanent number. It's a stable window that opened about a week ago and closes the next time the Fed moves. Let's break down exactly what this pause means, what it's costing you to ignore it, and how to lock in today's rate in under 5 minutes. Here's the part most coverage of this meeting got wrong, or at least left out. A pause isn't neutral. For your idle cash specifically, it's a green light. When the Fed cuts, money market yields fall within days, sometimes before you've even read the headline. When the Fed holds like it just did, those yields stay where they are. Stable. Predictable. Locked in for however long the pause lasts. That stability is the opportunity. You're not trying to time a falling rate. You're moving cash into a rate that, as of 1 week ago, isn't moving until at least late July. Let's make the cost of ignoring this concrete. $10,000 sitting in a checking account paying roughly 0.1% earns you about $10 a year. The same $10,000 in a money market fund at today's 3.6% earns roughly $360 a year. That $350 gap is the idle cash tax. And right now, thanks to the pause, that gap is as predictable as it's been in months. Scale it up. A $30,000 emergency fund left idle is leaving over $1,000 a year on the table, untouched, while the rate that would have captured it sits frozen in place by a Fed decision most people scrolled past. Now here's the part that makes this urgent instead of just interesting. The Fed's own dot plot, released alongside this same meeting, still shows the committee's longer-run expectations drifting lower, multiple officials projecting cuts later this year and into 2027. The pause doesn't mean the falling trend stopped. It means you have a known, dated window, roughly 5 weeks, where today's yield is the floor, not a moving target. After July 29th, that floor could move again, possibly down. So picture 2 people, same $20,000 sitting in a checking account today, a week after this pause. One waits until after the July meeting to decide. The other moves it this week and locks in today's stable rate for the next 6 weeks minimum, longer if the Fed holds again. Same risk. Same access to their money. The only difference is who started collecting the $360 first. Now, the obvious pushback, because a video that only tells you what you want to hear isn't worth your time. If stocks earn more, why does any of this matter? Why not just put everything in the market? Fair question. Here's the honest answer. Stocks have crushed cash this year. The S&P 500 has delivered strong double-digit returns year-to-date. If you're investing money you don't need for years, stocks will almost certainly beat a money market fund, Fed pause or not, and it won't be close. But that was never the real comparison. A money market fund has one job: protect the money you can't afford to gamble with. Your emergency fund. Your house down payment. The cash you'll need before the next FOMC meeting even happens, let alone the one after that. When your time horizon is 6 weeks or 6 months, what earns the most over time isn't the right question. The right question is, what's still there when I need it? If the market drops 15% the week your transmission dies, a strong year-to-date average doesn't pay your mechanic. So this was never stocks versus money markets. It's a checking account quietly taxing you at near 0% against a fund paying 3.6% for the exact same cash, with the exact same access, and right now, with a Fed decision about a week old guaranteeing that rate holds steady for at least the next 5 weeks. Here's the good news. Locking in today's rate, before the next Fed decision can change it, takes 3 steps and about 5 minutes. Step 1. Open a brokerage account, if you don't already have one. In the US, Fidelity, Schwab, or Vanguard. Free, fast, beginner-friendly, no minimums. Outside the US, Interactive Brokers for global access, or Trading 212 for a simpler app-based setup. Step 2. Find the fund that matches your broker. VMFXX on Vanguard. SPAXX on Fidelity. SWVXX on Schwab. All carry similarly stable yields in the 3.4% to 3.7% range as of this week, post-pause. Step 3. Move the cash. Type the amount. Confirm. Done. Your money stays exactly as liquid as it was in checking. Most of these funds let you access cash within 1 to 2 business days. One more move before you close the app. Turn on automatic dividend reinvestment. Interest pays monthly. Without reinvestment, it sits as cash again, quietly undoing the whole point. With it on, every dollar of interest starts earning its own interest immediately, free, automatic, and there's no reason to skip it. Do this before July 29th, and you've locked in the post-pause rate for the full window the Fed just gave you. Here's the uncomfortable truth this video is really about. People will refresh financial news for an hour after every Fed meeting, looking for what it means for stocks, for mortgages, for crypto, while thousands of dollars sitting in their own checking account never enters the conversation. Not because they chose that, because nobody connected the Fed's decision to the cash already sitting in their own account. This is you if you've got an emergency fund parked in checking, if you're saving for a house, if you're sitting on cash waiting for the right investment to show up, or if your paycheck lands and just sits there until rent comes out 3 weeks later. Nobody's asking you to take on risk. Nobody's asking you to predict the Fed's next move. You're simply moving cash from the place that taxes you for doing nothing into the place that's currently paying a stable, Fed-confirmed rate for doing nothing. The Fed didn't make headlines this week. The pause rarely does. But for anyone with idle cash, it just confirmed a 5-week window where today's 3.6% isn't moving, and the only question left is whether you act on it before July 29th or find out the hard way what the next dot plot decided for you. Stocks are still how you build real long-term wealth. Nothing here changes that. But the cash sitting idle right now, waiting to be invested or just waiting to be needed. The Fed just told you about a week ago exactly how long you have before that math changes again. Open the account. Pick the fund. Lock in the rate. If you want the full checklist, which fund to pick, how to set up reinvestment, and what to watch for at the July 29th meeting, comment cash below and I'll send it your way. And if this just connected a Fed decision to money sitting in your own account, subscribe to WealthStack. We translate what the Fed does into what it means for your money. Until next time, stop paying the idle cash tax.
Please note, this video is for educational purposes only and is not financial advice. Ensure subscribing to WealthStack so you don't miss out content like this. Note, rates and Fed projections mentioned are accurate as of the June 17, 2026 FOMC meeting.